This week we are focused on, well, for today's class, we're focused on analyzing our ratios. Just to quickly bring you back, we looked at ratios under three headings: profitability, liquidity, and gearing. These are our three here. There was three different formulas for profitability: gross profit, net profit, and then return on investment. Two for liquidity, current ratio and asset test ratio, and then one for gearing, debt to equity. So we've looked at calculating these formulas in the video that I sent up the last day. Again, you can pause, rewind, rewatch. That is a video that is on YouTube. It's available for you to watch whenever you want, and that's our solutions to how to calculate any workings you have for calculating these ratios. This is more of a long question than a short one for our next part. What we're going to be doing now is we're going to be analyzing our ratios. So as you may remember, for the Leaving Cert, you'll have to answer 4 long questions. I think this is a very nice long question. Why? Because the figures themselves are, they're black and white. You have figures that they give you in the question, and you know these formulas, and you're able to work out the answer. And if you're right, you're right. You get full marks. I think these kind of questions are easier to get full marks in because the figure's either right or wrong. Compared to some of the theory stuff where the marking scheme can be very difficult. This one, the marking scheme is just either you're correct or you're not. Okay, so once you're done calculating, I've gone through this before in terms of calculations for the different ratios, you're then going to have to analyze how the company is doing. And it's not just a quick comment, you'd have to be able to understand what each ratio means. So that's what we're focused on today. So I got rid of a load of slides. There's only 6 more. In fact, there's only really 5 more we're going to look at. I got rid of a load of slides because I kind of wanted to break this down and make it as easy for you to understand as possible. The 5 slides that I have here, I don't want you to take down now. There's no point in me saying take this down and waiting 2 minutes. You can take it down at the end. Once I'm done this lecture, you can go back and just go through the slides and take them down. The information on it is quite important. I'm just going to go explaining it first. So profitability. So these are our first two, our gross profit and our net profit. Basically, that's the percent profit we're looking for the company. So if you had a company like Disney and they were making 6% net profit margin, so that was their percentage, net profit margin every year, that's the amount of profit they're making off their sales. That's the amount of net profit. Or gross profit, it's the same thing. So this is before you take into account for expenses, and this is after. But they're both looking at a similar concept. It's the profit return. Obviously, you want it to be as high as possible. If I told you Disney are making 6% profits per year, back in 2007 they were making 16% profits per year. It was obviously better back when they were making 16%. It's quite simple. How do you increase your profit percentage? Increase your selling price or reduce your costs. Because this is a percent on sales, so obviously if you sell more, your percent will actually more or less stay the same. More or less. What we're looking at here really is if for any company, it's quite simple. How would you make more money? Increase your selling price, reduce your costs. The third profitability formulas are return on investment. This is obviously the return that the investors will get. It's your return on investment. So we want to increase their return as well, because if they have if their return is poor, they won't be interested in investing in our business. Think of it like, the Dragon's Den, those kind of shows. If they think they can make a high return, if they think the company will be very profitable, they can make a high return off their money, then they're going to invest their capital. So how do we increase the return on investment? Well, we can quite simply increase profits or put business resources to more use, which is easier said than done. What do we mean by put business resources to more use? It means that obviously, putting every penny to good use, that general saying that obviously, this is just generic stuff, but how would you increase your, your return on investing something. The money that you invest is put to better use in the company and increase the profits. For leaving cert business compared to accounting, you do not need to go into anywhere near the in-depth level that you would for accounting. So this stuff is a little bit generic. How would you improve your profitability? Increase your selling price, reduce your costs. How would you improve your return on investment? Increase profits and put business resources to more use. In other words, be smart with your money. Okay, slide 2. Our current ratio and our quick acid test ratio. There's an ideal range here. And our ideal range for our current ratio is 2:1, and our quick acid test ratio is 1:1. Now, it is favorable for those to be higher, but sometimes not extremely high either. So we generally call this the ideal range, but it's also favorable if they're a little higher as well. I'll show you that in a second. So these are our liquidity ratios, these two. It obviously are checking our liquidity. We would like to see the current ratio at 2:1 or higher. So what do we mean by higher? Higher could be something obviously like 3:1. It's the assets that would be higher. And the quick acid test ratio, we would like that to be 1:1 or higher. Obviously higher might here now might be something like 1.6:1. Obviously, we want the asset side to be higher because the assets is the money that we own. It's the short-term items that we own, and the liabilities is short-term items that we owe. We do not want that to be high. So, what happens if a company has a bad liquidity? And we'll be looking at this. We'll be looking at this for questions that are to come. If the company has a load of liabilities and they owe a lot of money, how do we improve these ratios? We can raise more money, we can sell off our stock for cash, or we can pay off our creditors. Raising more money obviously improves everything. Easier said than done, but that's it is a justifiable answer. Selling off stock for cash. So for these ratios here, what we're looking at is if I was to sell something and I was to sell it on credit from a debtor, I'm owed the money, but I don't currently have the money. So although my debtors are going up, I don't have the cash to spend, and that could be a problem down the line. I want cash. So if you're struggling here and your quick acid test ratio has gone down and it's 0.6:1, how would you improve it? Try to sell more of your stock now for cash. Sometimes companies might reduce their price just to sell it now. You hear that sometimes for someone selling a car, especially if it's a large purchase. If you buy it now, you'll get it for 20,000. But if you're not going to pay me, or if you pay me now, I'll give it for 20,000. But if you're going to pay over installments over 2 years, then it's an extra 4,000 cost. So it's favorable for companies to receive the cash now. So that's another way to improve this ratio, and by paying off people we owe, because obviously these liabilities are things that are hanging over our heads. This is money that we owe to our creditors. Creditors are people we owe money to, so by also paying them off. Liquidity ratios, just to show our calculations for liquidity, were up. These were our formulas, and to calculate it here, we looked at our current assets, including closing stock, and our current liabilities. So our current liabilities being the part of the balance sheet here. I'll just zoom in, where we have our creditors and our bank overdraft. So obviously we want to reduce this by owing less money. That's my second slide. After that, I am looking here at my debt to equity ratio. So for my debt to equity ratio is an analysis of the capital structure of the business. It indicates what proportion of capital is made up of long-term loans and what proportion is made up of reserves. In other words, if you have a restaurant in Castleblaney and the restaurant is worth, the whole restaurant's net worth is 400 grand, how did it get to be worth 400 grand? Was that all through loans? Was it all through debt? Or did you raise the money yourself? And that's what we're looking at for the capital structure. So if a business is lowly geared, and I'll go through that in a second, it means the majority of the capital has been provided by the owners in the form of share capital, money that you invested yourself, or profits that you've retained through the previous years. It's a good thing. So lowly geared is a good thing. it means the debt to equity ratio would be 1:1, which is kind of the ideal range, or lower, or well, ideally we'd have it lower than 1:1. We don't want our debt to be high. We want our debt to be low. So lowly geared means that you're raising the money yourself. A business is highly geared if the majority of the capital has been provided by debts. So long-term loans, you're starting up a business, you're starting up a restaurant, it's worth 400 grand, it's going really well, but all of the money that you've invested was been from loans, and that's worrying for the long term. So it's a worrying trend. Highly geared would be if the ratio is above 1:1, so it's 1.6:1. So once you've been given a question and you're doing the calculations and you work it out and you find what the um, the ratio is. What we're doing now is we're looking at, okay, so um, like for this example here, obviously their loans were massive. Their loans were 1.4 million and the capital was 700,000. It was a 2:1. Their loans were double the money they've raised themselves, so they would be highly geared. And that would be a problem for the long term because they owe the banks 1.4 million. This is just the one I used in the previous notes example. So if we want our business to be lowly geared, we want our debt to be low, how do we get to that point? So we want to be less reliant on loans, fueling our debt. In order to become lowly geared, a business must pay off those loans or raise more finance through, selling shares or basically making more profits and holding on to our profits. So that's the big two there. How do you, become lowly geared? How do you reduce the amount of debt that the business has? How do you reduce the amount of loans the business has? You pay them off, or you raise more money through selling shares. That's our equity. Selling shares are profits. So, if Facebook were in massive, massive debt, they could just sell 10% of their company for shares and, they'd make, whatever, a couple of billion, and they'd be able to pay off their loans. So that's what I mean by selling equity. So that's the three there that I want you to focus on for just understanding, what I mean by the formulas and what does it mean if they're good and what does it mean if they're bad. Those are three important slides. Please take them down in full. Just to finish, we looked at break-even point before, and we looked at limitations of break-even point. And that was actually done quite well in the Christmas test. We've also limitations of ratio analysis, and this will be quite quick. Limitations, obviously, a limit to something means that, it's something that could be holding it back. What's holding back ratio analysis? So this stuff is really good. We're calculating a different percentage, but, what's the limit? Like, what can't it do? So there's a couple of different things about what ratio analysis cannot show in a company, and I have them kind of in more detail here. I'm not going to read the slides. You can do that yourself, but most of it here is focused on, the inside of the business in terms of staff morale and things like that. So, industrial relations is the employer-employee. Ethical behavior, obviously, if there's a company that's, just dumping their rubbish at a local lake or something like that, and they're doing all these things that are unethical, and they're making loads of profits, but behind it all they're making unethical decisions. Maybe that could get found out in years to come, and that could damage the company. So you can take this stuff down. Even just an example, actually, something that maybe some relevant. Some of you may randomly come across videos on YouTube of the chat show, Ellen DeGeneres show, which would have been I think one of the highest, from a metric standpoint. I think it had like the second highest audience for any chat show in America, and but it's kind of fallen by the wayside because apparently there was major issues with the industrial relations between the employer and the employees. Basically, the staff were treated badly. So for all of the the different metrics, all of the different ratings they had and how good they were doing, behind it all, there was a toxic relationship there between the staff. And stuff like this obviously can't be shown. You can't show that in numbers. And that is a limitation because that's a potential problem for the business. Accounting policies, ethical behavior, non-financial information, and past performance. Again, just like break-even analysis, you could be asked what are the limitations of ratio analysis. And that is your slide. Again, please taking that slide down. Very quickly, who uses financial information? Investors, management. These are investors for loans. This is obviously management. They obviously care because they're the ones whose job is on the line. Our shareholders, if they invest money, they want a good return. Competitors would be interested, the employees in terms of safety of their job, and suppliers to get their money back, and the government for tax. All of these would be interested in financial information. We've gone through this before. If you want, you can add in just those one or two things just to make it easier for you if you needed to explain it in a short question. The investors would care because they want their money back. So they want to see, is the company able to pay off their loans? So you can take that down for investors for banks. Can they pay off their loans? Management, because it's their job. They're rated on their performance. So obviously they care about financial information and the financial situation for the company. The shareholders would care because obviously they're putting their money on the line and they want a good return. Competitors would be interested to see how your company is doing. Employees would be interested for their own job safety to see how the company is doing. And suppliers, because they also want their money back. They're paying you. Creditors sorry, they're giving you items that you're selling and they're waiting for their money back. Government is always for tax. So that's the end of that chapter, monitoring the business. I'm going to get you to take down that slide here. This one for limitations, that's a common question to come up. And these three here being important for explaining our financial performance.